Okay. It should appear here in a moment. It says excellent connection. Not seeing video yet. Yep, there we go. How about now? All right. Hey, so we're trying to get the connection here with Chris going, and it seems to be some issue with the stream showing up.
No, I don't see the stream.
Don't see it.
Nope.
It says it's streaming.
All right, well, if you want, we can just run through it, and I just won't see whatever you're talking about. I'll try and follow you on my Thinkorswim.
Yeah.
It'd be much easier if I could see what you were saying, though.
Yep. Yeah, I know what you mean. Well, yeah, it says right there that it's live. So, yeah, I see it. Click that link again.
What I'm going to do is I'm going to restart my iPad.
Okay. All right. So, sorry about these technical details. Yeah, I see where it says live. All right. So, today's February 17th, 2021. This is the second time we're trying to get this going. So today we're going to talk about some of the events from the market going down in the morning. It's kind of a shakeout, and then it looked like it recovered. But whether it continues higher or goes lower, we want to have a plan in place based on that. So we're kind of on shaky ground right now. And I'm going to talk about some of the things that are on my radar about that. Chris has a watch list, some stocks on his radar we'll go over. And I also want to review some sectors today. So, Chris, are you able to see it again? If you pop that link open, like I see it when I click the link, I see that it shows that there's a red live broadcast.
I am signing into Twitter right now.
Okay. And it looks like, it looks like it's visible to me. So we'll go ahead and keep going, and hopefully Chris will be able to get his video going. So yesterday in the broadcast, I talked about NVIDIA, a position that I had on. It's not a position that I carry into expiration unless the stock is super strong, and that means like almost every day. It's a 2-week long position. I'll go ahead and bring up the trade right now, and I punched out of it real early, and it basically like lost all the profits. It gave back almost all of it. Okay, it's showing up now. Awesome. Okay, so audio. All right, cool. I think what it was with 2 days to go. I put this on 3 weeks ago. It was a back spread with essentially 15 points apart. That's not right. The 550 here. Yeah, how's the video look? Is the video quality good? Because I'm trying to turn that up.
Looks good. I am trying to broadcast on my TV right now.
Okay, great. Okay, so I just built this back spread. It's got 2 days to go, and there's a lot of time decay that happens in the last 2 days on these. And so at this point, I'm looking out at next week's stuff and not so much this week for these kind of back spreads. So looking at this trade, let's zoom into a 10% move here. Like as you can see, like as NVIDIA continues to fall, this trade really starts to go into the hole and lose money if NVIDIA falls much. And so I ended up giving back a lot of profits. NVIDIA was up here around 610. And so this trade had about a little over $2,000 of profits per contract yesterday, or per combo rather. And today, with NVIDIA sliding back down to below 600, it kind of put the trade into the zone where it really starts time decaying. And if you try to hold it till expiration in that zone, you're looking at probably giving up all the margin you put in. Plus, if you pay the debit, then you're probably going to lose that too. I did not pay a debit on this.
You know what?
What's up?
Real quick, I hate that. You're in a good trade, right?
Mm-hmm.
And little shakeout takes away your gamma, your delta, it increases your theta, and you lose so much, and it's like trying to fight an uphill battle once it starts going back up, because you have to rebuild the delta, rebuild the gamma, knock down the theta, and it's like you may as well just get out, because it would have to go up like 1.5 times where it originally was, in order to catch back up.
Right. And the other problem with this is, like, normally I'd be rolling this. The problem is NVIDIA reports next week. And so if you look at rolling this trade, like look at it this week, it's, like a small credit here or whatever. But if you try to roll this into next week, let's look at what that is. So here's what I'm going to do, Chris. I'm going to, Feb 26th, we're going to sell a 550. We're going to buy a 565, and we're going to buy 2 600s. And you'll see that, like, it just doesn't work at all. It doesn't look anything the same on the chart here.
550, 550.
It doesn't look right at all. And, like, look at the loss. The loss is huge, and here's the reason why. Or the potential loss could be huge if NVIDIA doesn't really go anywhere. Because guess what? That's that earnings implied volatility. And you're going to find this in weeks after this week, too, if you're looking ahead. So what I'm doing is I'm actually flipping over to Tesla. And I talked about this last night. I flipped over to Tesla. I have a similar trade on Tesla because Tesla doesn't have earnings coming up. I'll show you what I did do with NVIDIA, though. I put something on.
You were Tesla out? Because I was just looking at NVIDIA.
Yeah, no, I'm still looking at NVIDIA. I want to show how you can play the implied volatility and make money from it. So everybody knows about selling credit spreads, but the problem with that is there's an extra risk of early exercise with credit spreads. And so if you actually flip it around and build it as an in-the-money bull call spread, if you're trying to play the bull side, we'll look at a couple of these. So I'm going to clear all these legs off. Okay. And let's look at an in-the-money spread. So NVIDIA right now, let's say it's, let's do this. Let's buy a 560 and sell a 590. Let's see, how does that look? So this spread is fully in the money. We need to figure out exactly where NVIDIA closed. Let me look that up because these option prices are stale. And
you're selling a 560 and buying a 590?
No, other way around. Buying a 560, selling a 590. If I said it the other way, I'm sorry.
Okay.
Yeah, so we're actually flipping it around here. Yeah. So NVIDIA hasn't moved in after hours. So this spread is fully in the money. And what I normally like to do is I'll use the ATRs to figure out how wide to make this. Like I'm just guessing. But if you notice, this is a 30-point spread that you can buy for a 20 debit, right? Or less. I mean, if you get it near the bid, if you get it near the bid, then it's actually closer to 15, and you could double your money if you get it near 15. If you get it near 20, you can make 33%. But the point is, NVIDIA's share price doesn't have to go anywhere. It could go sideways, and you're making like 50%, even if you get it for 20. So the other thing we could do is we could look at the other side too. Is we could do a in the money put spread also. So I'm going to go out and do. I'm going to buy a 630 put and sell a 600 put. And so this whole thing, this put spread is fully in the money as well. Bad news is that we've got to plunk down $4,000 per combo on this one. But the good news is, if NVIDIA doesn't go anywhere, then you can make 50%.
Because the implied volatility is going to skyrocket.
Well, it's skyrocketing now. You mean like after earnings, the implied volatility get crushed And so, yeah, I mean,
No,
it's
no, you can't hold this after earnings. You have to close it all out before earnings the day before. Oh, I'm sorry, the day of, not the day before.
yeah,
And that was something I learned from John Carter. Is he does straddles or he'll do strangles, and all he does is you got to forget whether it goes up, down, sideways, because you're going to make money on both ends of this just because of the implied volatility that's going to get cranked up as you get closer to the earnings date.
right.
So, like at 3 o'clock or 2 o'clock the day before earnings, make sure that it's, reporting the next day and the afternoon.
Yeah, let me pop the chart of this spread up on the screen so that people can see the chart of it. So this is a short iron condor, is what is what IB says. So let's do this. Let's do a new chart. And so essentially, like, we could expect this to continue to rise into earnings probably. We're looking at hourly candles. Yeah, that's interesting.
So, yeah, I mean, if NVIDIA is notorious for getting well above 63% the day before earnings, you'll be at least 100. And that is just going to pack a ton of premium into these strikes.
Yeah, and if we wanted to reframe this as a strangle, we can. We can reframe this as a strangle. It's very similar.
Oh no, I wasn't implying you should change your trade. I'm just saying you can pretty much do anything, and as long as you're both sides of the chain, you're gonna make money.
Yeah, I mean, the thing about this for me is, like, I have a bullish slant on NVIDIA right now because of the research I've been doing, but I'm not a big pre-earnings player. Like, I don't typically put stuff on ahead of earnings. I will on occasion, and I mean, there's some people that all they do is play earnings. That's not really my specialty. So let's reframe this as a strangle, and just for illustrative purposes here. So what we were looking at before, if you're gonna do it with a strangle, essentially like move what we were doing on the call side. Just slide across strikes and do it on the put side. So you're going to sell a 590 put and buy a 560 put to cap the loss. Okay, and if you just look at that one by itself, it takes $3,000 of margin, and the max return is 1,000. So you see, it's a very similar trade. I mean, I guess it takes actually slightly more margin, except for if you do the other side, it doesn't. So that's an advantage there. So let's do the other side. Let's go into the calls, and we're going to sell a 600 and buy a 630 to cap it. And so now,
Hang on 1 second. I gotta disconnect for a second.
Just go on mute. Can you mute?
No, actually, yeah, I think I can.
Okay. So if you look, the graph looks the same, and so this only takes $3,000 to put on instead of the $4,000 we were looking at for the debit spread version. But the max return is essentially the same. It's that $2,000, which I guess on a percentage basis is slightly higher, structuring it like this. But the graph looks the same, right? Like if NVIDIA doesn't go anywhere, then this makes $2,000 per combo. All right, so I'm going to flip over to Tesla now, and let's look at that. So I watched a really great video from Samantha LeDuc yesterday. She put a YouTube video out. It was her macro to micro interview, and the guest she had on, I forget the guy's name. Sorry, dude. But great interview, and they were talking about how Tesla, Bitcoin, and some of these blockchain miners are all kind of wrapped up in the same trade right now. And they're looking at some of the systemic risk in the system from call options moving markets on things like GameStop and how that's correlating to big spikes. And so that's like a really interesting risk in the system right now that we're seeing. So great video. If you haven't seen that one yet, I recommend that. And one of the most shocking moments of the video is Samantha puts up a chart of it was earnings. I think it was earnings growth and the correlation to the market. And it lined up until the last year or two, like this major bull run we've had since March. And what she noticed is, if you dive into the data, you find that it's Tesla is the difference. It's all Tesla. Why this rally is not an earnings-driven rally like rallies in the past. However, with Tesla taking Bitcoin onto the balance sheet, yeah, they might be making earnings right now, and if Bitcoin continues to go up, I mean, they've essentially linked the S&P 500 to Bitcoin now, Tesla. So that was kind of a topic on the show. It's really great. And so here's something else. I was watching a stream today. Gosh, I forget this guy's name too. I'm sorry, I'm so bad with names, but he was the longtime Tesla bull. He's long Bitcoins and cryptocurrencies, and he went in and bought some Tesla puts, like for the first time ever, and he regretted it like instantly. But there's a lot of people looking at Tesla saying like, "Hey, this thing is now like systemically linked to the market." So, looking at Tesla here, that shakeout was scary today. So, by the way, Interactive Brokers here is in paper trading mode. Just an FYI, this is not my account. Just so you know, it's just like a paper trading thing here. All right, so Tesla has some real systemic risk to the system at this point. So here's how I'm playing Tesla. Oh, wait, maybe before we jump off NVIDIA, I should just mention that I did pick up one 6:30 call. Here's what the chart for the 6:30 call looks like. It's pretty wild. I mean, it can move big if NVIDIA runs up into earnings, and like I still think it does, but I don't want to keep that back spread on that we were looking at, because I don't like holding it in the week that it expires, and I can't roll it. So instead, what I did is I bought I bought one of these calls, and I bought some of the other calls out here higher up too. All right, so let's jump to Tesla now. So I talked about yesterday the position I had, and I pointed to the Tesla chart, and I said if Tesla goes down, then let me get a Tesla chart up here real quick. All right, let's get a Tesla chart.
Tesla looks a lot like NVIDIA.
Hang on, that's Nokia. All right. Monthly.
No, I already have Tesla up.
Oh, okay. Yeah.
It's pretty similar.
So I pointed out that it's got this 50-day moving average support right here. And the 50-day moving average is 761. it didn't quite hit it. It went down as low as 700 and... Yeah, I mean, look at that. The low today, 762. So it basically bounced right off the 50-day moving average, the simple moving average.
I don't know. They both look choppy, man.
Yeah, but there's a pretty strong support here. So the position I had on was, it was a back spread. And what's nice about a back spread is that the price moves against you, then you can essentially just roll down on strikes basically for free. I mean, it's not exactly free. There's transaction costs. You might have to pony up a little extra money, but it's not bad. So I actually did that. I rolled down in strikes on Tesla today. And so I want to show the position, or at least something close to what I have. So I think what I rolled down to was a set. Yeah, this is what I got. It sounds like you're moving out of your house over there, Chris.
I am. My laptop is starting to get hot, and I'm looking for the damn cord for the fan that I have underneath.
I got you.
Oh well, the burns up. I just can't find it. I don't know what to do with it. I checked every freaking pocket in that thing 3 times. I'm sure you heard it all.
Yeah. Sorry about that, dude.
There's nothing you can do about it. Oh, you know what?
Find
I
it?
just remembered. Well, underneath, there's a spot for the cord.
Oh, got you. All right, so this is the back spread that I rolled down to. I sold a 760 and I bought a 775. And so what that does is it establishes a credit with for 1,500 margin, and then I use the credit to buy 2 out of the money 870s. So 870 is at near the very top end of the range that Tesla's been in for pretty much all year. And so I was really hoping that it would slide lower. The other thing you could do is, if you don't want to do it quite as aggressive as of a ratio spread as this, instead of doing 2 870s, those add up to like 12 or 13 bucks. What you could do instead is you could get like a 1 840 instead of 2 870s. But it makes it a lot less explosive on the top end. So with this back spread, it's a ratio back spread. With this one, I could essentially put the trade on for 1,500. And I mean, I didn't pay $4 debit. I think I paid a really small credit to roll the one I had, but it already started making money. So I could post 1,500 per combo, and I'm essentially, if the low is in on Tesla, then I'm in at the low. And if you look at where this thing starts breaking higher, it starts breaking higher. Hang on, Micah's calling. I'm going to tell her, please text me. She doesn't know that I'm streaming. All right. When she gets home, she'll find out. I should have sent her a text, man. That was like super irresponsible. Anyway. So it started to make a little bit of money, but these back spreads, the real money made on them is, if you look at it, this one has like 10 days to go or something. Expires February 26th. So that's like 9 or 10 days to go. So we've got Thursday, Friday, through the weekend. Monday, Tuesday, Wednesday, before we really start catching a lot of heat on a position like this. So let's look at what it looks like then. So if the price stays low, then we're taking some heat, okay? We're going to lose the $400 of debit, which actually in my case is profit, because I bought this for basically nothing. Plus, you start looking at losing the credit. So the margin you posted. So you'd be down about $800 in your margin by Tuesday or Wednesday if the price stays where it is. However, if Tesla if there's any kind of price movement whatsoever, you're in a much better situation. And I like that with Tesla at that kind of bouncing off that 50-day moving average. I think we're either it's going to tank, or with Bitcoin running higher, it's actually kind of likely that we could expect some surprise upside. Like if Tesla buys more Bitcoin and announces it, which could be a reason why Bitcoin's running higher, and why Riot Blockchain's running higher, and Marathon Patent Group. All right, hang on. She's calling again. I have to text her. Write a message. Hang on. Sorry, everybody.
Think about Elon buying Bitcoin.
Yeah, he all right, streaming right now. Okay, I just sent her a message. Yeah, I think if he already has purchased 1.5 billion Bitcoin or something like that, and if he makes a surprise announcement that they purchased more, the market could view that very favorably or very negatively. If they view it very negatively, well, look, I mean, that $4 debit to put this on is actually, for me, it's a profit on this trade because I put it on earlier. So I lose the profits, but the trade essentially breaks even at these lower prices. Well, I can reset the trade at lower prices, or maybe roll it out a week further too on the calendar. At this point in the week, going into Thursday and Friday, I'd be looking at rolling it out if I adjusted it all. So it would have 2.5 weeks on it. And what you may have to do is widen it so that it's got a little more margin. That's something you can do. But I mean, the potential upside here, if Tesla does hit new highs, it's got resistance under 1,000. But if it gets up to 1,000, I mean, look, that's ridiculous. Post $1,500, make 30 grand per combo.
And they already split too.
Yeah, they already split. In stocks like this, they tend to split a couple of times before they're done.
Yeah.
So, if it's got another split in it, that's probably over 1,000 a share. That would be my guess. So the point is, this is major firepower here. And, I'm posting 1,500 margin per combo. Really, as long as I don't hold it until expiration, my risk is much lower.
Right.
So, anyway, it's those last 2 days that you really have to watch out. That's where you can get in trouble on these. The other way you can really get in trouble on these is if you hold them all the way, if you put them on during an earnings report. Yeah, sorry, Micah's texting me. She said, "Hurry up, please. Hurry up." What? I mean, I'm streaming. I'm not gonna be done streaming just because she wants to have a phone call. Hopefully, she's not stuck in the ice. It's really bad weather here. If she is, then I'll have to jump off of here maybe and resume. But the streets are pretty clear. I don't think she should have a problem. And I shoveled the driveway for her. She doesn't know that yet, but I did.
I ended up buying a snowblower because I realized that I actually thought that we were going to have blackouts here on the East Coast, and it turns out that the West Coast is having blackouts. So I got my generator all ready this summer because I thought it was going to happen during the summer. I thought we were going to have rolling blackouts because of the heat. So I also bought a snowblower because we haven't had any snow in New York since the late 80s, early 90s. And sure enough, COVID has really had a dramatic cooling effect across the globe. And I am not a climate person per se, but I do believe that due to all the emissions being gone.
Oh yeah, the drop. Yeah, interesting.
Yeah, it changed. It does change the climate. It raises the ceiling, and there's not as much warmth, trapped in the earth. So I expected a nasty winter, and we're getting it.
Yeah. So people might be wondering what I'm drinking. By the way, tonight I got a Lagunitas Hazy Wonder. Is what is going on right now over here.
Nice.
Yeah, these are tasty. I like Lagunitas. One of these days on the stream, I'm gonna teach you guys how to make an oil change. I mean, that's my drink, man. All right. Yeah, it's awesome. I'll show it, but not tonight though. So the other thing I wanted to show everyone too is, it takes a 30% move to make 20x on the money you're posting with this ratio back spread. I want to contrast that, and by the way, like, depending on how you manage the trade, it can be very low risk. I mean, this is like an actively managed position. So let's contrast that to what it takes with what people are typically using. They're using out of the money calls or out of the money bull call spreads to generate similar kind of 20x kind of returns. There are fewer drawbacks with this, in my view, than those other ways normally. The reason is because the time decay is the main thing hurting you with this back spread. If the price moves anywhere, then it's helping you. Like any kind of price movement at all is helping you. Even if it's just knocking the trade back to break even, you can reset it, or get your capital out and put it somewhere else, whatever. If the price moves against you. So let's compare this to like a bull call spread that has a similar time frame. So I'm looking 9 days out. Let's find, like, first of all, just a straight up out of the money call that gives like a similar kind of rate of return. I don't know what it would be, like an 890 maybe. So with this one, we put up $5, and so for $500, we can make 15 grand. What is that? 30 times the money? All right, so let's walk it back to a 20 times the money one. What was I looking at? 870? Let's look at 860. Yeah, here we go. So this is comparable. Looking at an 860 call. If you hold it till expiration, you could, if the price is below 860, 870, I guess. What's the break even? Yeah, 868. Then the call is worthless. So it's got some pretty heavy time decay. But the other problem with it. Yeah, the other problem with it though is if the price moves against you, that $8 is going to be $4 real quick. Like, that's the problem with it. It loses money from adverse price movement, not just time decay like the other one. And so, if it fades against you, you could buy another one that's, similar distance out. The problem is you're out to $800, whereas with the back spread, like I showed, you're not. So, I mean, I'm not saying that this is like better or worse. It's just different. And for the way I trade, it's less good generally. All right. So what's next? We're going to look at a bull call spread. So the bull call spread will be slightly closer in. That's what's nice about the bull call spread, is it takes lower strike prices to get some kind of a return profile like that. So we're shooting for, the benchmark here is a 30% move, make 20 times the money. So that's what we're essentially trying to stack this against. I'm just guessing here. I'm going to buy an 830 and sell an 860. Return to risk. Yeah, and this is nowhere near close. This is only 3 times the money max that this can make.
I should probably go over into my paper account. I'm following you in my real account like a knucklehead.
Yeah, the problem with that is you can accidentally submit an order, not notice it, things like that. I mean, we've all been there. Yeah, I mean these bull call spreads. Let's see here. The return to risk on this one's 5. Like it's you really got to come in on the calendar in order to get something that looks juicy on the bull call spreads. The 840, 880. What does that look like? Here we go. That one's got a 20 times return profile. It's only got 2 or 3 days to go, and Tesla has to go up, what, like 10% in order for that thing to work? It's got to go from like 800 to 880 for this to work. So, I mean, I'm not saying that that's not going to happen. It could, but I'm not crazy about this one. So, I think I'm done looking at Tesla right now. Did you have anything you want to add on Tesla, Chris, before we move on?
No, sir.
All right. Anything on your radar you want to jump to before we start looking at sectors?
We can, or we can do the sectors first. It's up to you if you want to take a break, and I can jump in a little bit. We can look at some of the ones that I was looking at.
Yeah. Hit us with some of the stuff on your list.
All right, so exact sciences is the first one that I really want to discuss. I don't know if everybody realized exact sciences was not, let me pull it up, was not quite the ticker it is today. Way back when, like in 2016, 2015, I think it was $4 or $5 a share. And it's grown exponentially from there. But what caught my eye is in Thinkorswim, you have an ability to look at you can compare all the earnings reports, and I've noticed that their earnings reports are starting to decline. They also, which caused me to look at their revenues, and then I noticed that their revenues are declining, which made me to look at the price action. And what I noticed in that is that in the daily chart, they have a negative divergence. And negative divergence is where you have a higher high in the price action and you have a lower high in the RSI.
Yeah, I got the weekly chart up because it's got, you're given that long price history back to 2016. Yeah, I mean, this thing has been on a monster run. And what we're seeing right now on the weekly, before I flip to the daily, is the MACD looks like it's about to show like a rollover on the MACD.
Yeah, there's an outside candle on the weekly. This thing it looks done. And I would just be extremely bearish on this. So what I do...
Oh, there's volume coming in today, too. Wow. Okay.
Say again?
There's a lot of volume came in today.
I do not have my volume pulled up.
Yeah.
So for the trade...
Okay, and by the way, like the divergence that that I'm seeing on the daily, just to kind of highlight what you're saying is, it's dropping. The MACD's been trending lower on the daily since November, despite the price going higher. And so, you know, like, I don't have an ADX on here, but I would guess like an ADX might show that, you know, the trend is running out of gas.
Let me pull up the DM. I actually have that study. Oh, no, I don't. I have that study over in my regular account.
So, by the way, it's at the 21-day exponential moving average right now. Like that's where it closed right below it. So if it closes the week out underneath that 21-day, that's probably not a good sign.
Right.
Okay.
What?
Go ahead.
No, I'm having a little issue with my computer. Here we go. All right, ding dong.
EXAS. Yeah.
There we go.
Yep.
All right, so since you know we have an outside day on the weekly and falling revenues and poor earnings, and it looks toppy, even with the RSI. And this negative divergence, I would like to go out to the 12th of March, and I would
12. Okay, March 12th. You're talking about you're building a combo now.
I mean, no, just straight directional.
Okay. All right. I got March 12th up. What are you getting?
I'm going to sell the 148 strike in the calls, and I'm going to buy the 141 strike in the put.
Okay, hang on. I just caught up to you. March 12th. Okay, what's the trade?
Sell the 148.
Call.
Right.
Okay,
But
selling.
now these numbers are not correct. These numbers will adjust once.
Okay, so you're essentially trying to make the put a little cheaper by selling the call, right? So it's like it's a very bearish trade. Okay,
But
so
it's a very bearish chart.
yeah. So do you have this?
If this goes against you, you have to exit, or you would have to put on a hedge.
Yeah.
So,
So do you have this position on, or is this something you're looking at?
This is something I just did, like I told you before we went live. I just started doing homework for the homework.
Oh, got you. Okay. Yeah, I just wanted to be clear for everybody watching this, if you already have the position on, or if it's something you're looking at putting together.
No, it's something I'm looking at, and
Okay.
if I was to be worried about it going against me, I would either go UVXY, VIX, some type of volatility, because if it's going to affect something as big as EXAS, it's probably going to affect the market somewhat somehow.
So this is very similar to a synthetic short. It's just that you've got the strikes. The one you're selling is you know it's further out, and the one you're buying is closer to the money, or I guess it's slightly in the money. So one thing you can do on these is sometimes, and you know the options are super wide on this. If they're not, sometimes what you could do is, in order to get the margin impact lower, you can buy something that's like out of the money just to kind of cap the risk on what you're selling. But the bid-ask spreads on these options are so wide, I would not try to do that.
They do get closer in the morning.
Yeah. So like finding liquidity would be helpful when putting on this trade.
Right.
Yeah.
I would hit this trade right now. This would be, I guess, the best time to actually have this discussion would be during market hours.
Yeah, but I mean, I'm not trying to stream during trading hours because you know that's a whole different thing. There's a lot of people that put out garbage during trading hours. They're cheering for Bitcoin. They're cheering for GameStop, and I mean, there are some good streams. Don't get me wrong, but there's a ton of garbage out there too. So anyway, like I'm not trying to like jump in on that. Like for me, it's I can speak calmly and rationally about all this when markets aren't moving. But when markets are moving and it's trading time, then like I like to have my homework done and out of the way. So anyway, but go ahead.
So anyway, I guess I am just trying to say that I'm very bearish on EXAS, and there's a lot of indications that I've seen that are saying that. Now, I haven't even done any Fibonacci on it yet, but if I come back tomorrow, that's something that I can do, and then somehow I can get a chart over to you, or I can, we can just figure out a way to get charts to one another, and that way you can post it up so people can see it.
Yeah, that's a good idea. I like that. You know what I could do is either you could tweet them, and I could show them here on the screen, or maybe you could. The other thing you could do is email them to me. But we'll get that set up for another time.
Tweeting will be awesome. Yeah. Okay. So yeah, I'm bearish in XAS, and that's what I would do. Is I would be very, very aggressive on this. And I think that 23 days is plenty of time, especially since it posted an outside candle on the weekly.
So something we can also look at is I have another window open here. Let's see when they report earnings. Okay, May 4th through May 10th is when they're looking at. The other thing we might want to be aware of is that they have a dividend date coming up, and they do not. So those two factors are important. The other thing that you can do, Chris, is you can look at the open interest, which is what this column is. The options open interest, you can look and find strikes that have the most open interest, and that's where you're going to get the most liquidity. So this one, it's
set up on my paper account. I have all that stuff set up on my live account.
Yeah. So with these strikes on this weekly, like, there isn't a whole ton of open interest, but if you look at if you look a little further out, March 19th, that's the monthly expiration. There's a little bit more open interest there. And so if you're going to be looking at March 12th, I suggest also look at March 19th, and you might get more liquidity there. And it doesn't mean that the bid-ask spreads are necessarily going to be narrower, but what you will find is when there may be someone trying to exit their trade at the same time you're trying to put yours on, or close yours. Yeah, there's a lot more open interest on the monthly. And so, like, this is a stock that I'm not sure that they should necessarily have weekly options, because what that does is, it makes the options liquidity really thin everywhere. If a stock like this, if they only have monthlies, then everyone's forced to put their trades on where the monthlies are. It's kind of a two-edged sword. Like, if you have weekly options, it encourages more people to, like, put on strategies, and so you get more activity there. But it also spreads the liquidity around, so it spreads it thin.
It's easy to borrow, so you can just short it.
Oh, yeah.
My point is that it's garbage right now. It's what it looks like to me.
Yeah. All right. Well, let me play with this one a little bit and see if I can find something that I like here. So I'm going to look at. I like looking about your 3 to 4 week time frame out. I like that because there's enough time that if this market has a hiccup, that it could fall into that window. So let's see here. What about just buying an at the money put? What does that look like? So I'm going to look at the 140. Let's look at the 140. So that takes a pretty big debit to do it. What's the implied volatility here? It's not too unreasonable. I don't want to do a ratio back spread on this because it's not liquid enough to easily get in and out. So I'm going to rule that out. And a lot of the open interest there's actually like a lot of open interest out in front of the price on the put side. So what if we do this? Let's do a bull call spread. We're gonna buy. Let's buy a 145 and sell a 125. What does that look like? Okay, so you could buy it for $10, and you could make $10. So you can make a 50%. I'm sorry, you can make 100% return right here. And if it moves against you, is this better than the synthetic short? I don't know. Like what you had on, I would say, is like a modified synthetic short.
Mm-hmm.
I don't know that this is better. All right. Well, I mean, your trade idea is pretty good. I like it.
We can go to a different one.
Okay. What do you got next?
Let me see. I got a few. Oh, the one that you pointed out to me that I said I liked, Corsair. So
yeah.
I did a little, and I'm not bearish this. I did a little bit of homework on it, and the BDTS is 101, which is the I can't think of the name of it right now. The book value.
Okay.
Book value per share is 101. It's trading at 40. That in and of itself tells me that this stock is way undervalued. On its recent descent, when you pull it up, it just posted a hammer on the daily.
Yeah, I was looking at that today. So I'm in this. I think. Yeah, I think what I have is I don't know if I rolled it down. I think I did. I originally bought a 45 call, and I bought a put, like in a swoosh position. But I had to do it weird because I think this only has monthly options. I think what I did is I just rolled the 45 down to a 40, and I think I paid a debit to do it. If I'm just going from memory here. I mean, I got so much stuff on that I don't even remember it all. Which, I mean, you could say that that's bad, but I'm constantly reviewing things, and just I know what I'm doing with each one of these positions. All I have to do is just take one glance, and it's like, oh yeah, that's what this is. That's what I'm doing with it.
Right. So John and I were talking the other day, and I had said if it gets down to 38, I would jump in.
Right. So there's a range, and it's like normally this Bollinger Band might be painting the range, but the 21-day EMA is at 41. The 50-day moving average is 38, and so that 50-day moving average also happens to line up with. Chris noticed that there was a channel, an ascending channel. With the low around 38. And what's the low of today? 38.5. So, I mean, you were right about that. I was thinking about it too when I looked at this thing today. It's like, oh yeah, I'm in it already. I'm not going to buy more till a breakout, but if I even add to it. So
yeah, I am. Even if the market does decide to crack, I am still bearish. I mean, I am still bullish this.
Yeah, now do you wait for a breakout? Or, I mean, everyone's style is different. I like to buy kind of in where a handle would be. And it's a little low in the handle, but it does coincide with the channel and the 50-day moving average. Like, it does have a support level here. And it doesn't look... I was just going to say, it doesn't look like it's ready, to be off to the races just yet. So... putting on a swoosh position, I've got to roll those short-dated puts, and so I am incurring a carry cost there to have it. But it looks like, it's in a base. It looks like it's still in a base. That's the game, right? For at least for now.
If I get a green candle or a new white soldier, I would jump in.
Okay. You know what would be great to see is maybe like a week's worth of tight closes right here around 40, like above support, above that 38.5 level, the 50-day moving average. If we get a number of tight closes there, I'll tell you a stock that's famous for doing that is Beyond, BYND. And I've been tweeting about this one and trading it for years. But like, I just brought the chart up, and you'll see like this thing will just make like a ton of tight closes, and then it'll either like, get smashed down out of it, or it'll like explode higher out of it. Like it just.
Okay, I see it. So it likes to form a bottom.
Yeah, it likes forming these like really tight run of really tight closes. It does it all the time, and like you can zoom out and you'll find them just all over the place on this chart. But let's jump back to CRSR, because I'm just calling that out as, that would be a constructive thing to see on this chart right now, is really tight closes, and maybe even on a weekly basis. If it can make some tight closes, maybe after like coming back up near the top end of the range, make some tight closes there. Like that's kind of your sign to like pay attention, get ready for a breakout.
But I mean, even if this is a one standard deviation move, right? Like it's $9 from peak or trough to peak, or peak to trough. It just keeps doing it up and down and up and down. It's the same range. It's $9, $9. I mean, you can't just let that go by without taking advantage of it. Now it's been going on for a while. I don't know how much longer it's going to go on for, but if I got another green candle, I would get in and ride it to the top, which would be right around 50.
Yeah, I mean, it's a good point. Like this is a new stock, IPO'd. Well, at least I'm assuming that's an IPO. There's other reasons why a chart can just appear out of nowhere a few months back. But, this chart data only goes back to a $17 price level in late September of last year. I'm assuming that's an IPO.
It was.
Yeah. So, I mean, I wasn't in it at the time, but it already had its IPO run up. And then now it's in what I would say is really its first real base. And a lot of times these first real bases can be great opportunities. So, I mean, if you look at a lot of these stocks, like a lot of them, they'll make one really great base, and then they'll start running. Like Taser was like that. It ran up, when it IPO'd, it ran up, and then it made a base for a long time.
My eye was the book to value. I mean, the book value per share.
Book value per share. All right.
That just shocked me when I saw that it was 100 more.
Yeah. Let me get that up on the screen. I'm going to go to Yahoo Finance. I don't know where you're looking at that, but
I get it off of Thinkorswim.
Okay. Well, I'm just going to bring that up on Yahoo Finance. Let's see what they say. It may not agree. It may not be exactly the same.
That's fine.
Yeah. I mean, and they may be more outdated than your trading platform. At least that's my experience. Let's see here. Where is it?
Let me pull up my fundamentals.
I think that's one of these key statistics in here. Okay, price to book. Current it's showing 9. It's showing 9. So, but that
book value per share 101.
Okay.
61. And when you're looking at the price to book?
Well, I've shown like Yahoo Finance is showing like a slightly different ratio. They're showing price to book.
Right. I'm looking at the book value per share.
Oh, yeah. Book value per share is different. That's a different metric than the price to book. Oh, there it is. Book value per share. Yahoo Finance shows the NA. So it doesn't have that data. It's missing something.
Okay.
Yeah.
Their revenues, 55. I'm assuming that's million. And their book value per share is 101. I see the price to book, which is 761, and then the price to cash flow ratio, which is 21, and then the price to ER is 39. Or earnings ratio, rather, is 39. But so far, for an IPO, they have grown quarter by quarter.
Yeah, that's good. Like it turns out, like earnings really do matter. Like earnings per share, it matters. So, all
Right.
right.
So anyway,
What's next?
that one. So I was bullish that one.
Yep.
I didn't even have a chance to look at the options, so I can't really speculate.
Okay, I could show what I have on this one. Just give me a moment. And again, I'm just guessing. I'm going from memory here, but I'm pretty sure what I have is an August 40. And I think what I have here is a March 30.
August.
I think I have 2 March 30s. Yeah, I think I have 2 March 30s. Let's look at that.
40 call?
Yeah, August 40 call. I don't think what I have is May. Although it might be a better way to put it on. Probably, it's let's look at it with the May one, because I mean, if I were doing this today, I would probably put it on with the May one. So a May 40 call is $8.60.
Right.
And then if you want to protect that, it's got pretty heavy time decay, but it is kind of far out. But I mean, you can see on my screen. What's that?
I'm pulling up my delta gamma theta vega. There we go. All right.
Yeah, it might be that what I have is a single 35 put. Let's see what that looks like. Yeah, I mean that looks actually pretty good. So a May 40 call for about $9, and a 35 put for like $2. That's a swoosh. And this is gonna, because it's monthly options. When you get really close to like the beginning of March, you got to figure out what to do next, because you don't want to sit on that March put for too long. It's not the protection that it provides goes away.
So I see what you're doing here. You're looking for longer term growth, and you're protecting yourself with shorter term downside.
Yeah, exactly. That's right. And what happens when you short date the protection? What that does is when the stock takes off, then that protection becomes a smaller and smaller part of the combo, to where it just keeps shriveling up until it's really just nothing at all. If the stock goes on a run, yeah, even if you're rolling it still is essentially worthless. And that's what you want. I mean, the alternative is you buy these calls and you're unprotected. Well, what I don't like about that is if the market crashes, I got a ton of puts in my portfolio, just on all kinds of stuff. And so, this lets me manage the time decay, is where the loss is coming from. And I can manage that. What I can't manage is a portfolio that just goes all into the toilet all at once. Yeah. So, I mean, this looks pretty good. If I was putting it on now, and what you could do too is, when you roll this March one, you could look at maybe, they will introduce a June monthly contract, and when they do, you can roll the May one into that.
Right. I'll be honest with you. I am not a longer term. To me, this is long term.
Well, I'll put another. I'll give it another name. It's position trading. So what I do is position trading. But I mean, these are compatible in the sense that we both have to have an awareness of what players doing the other activities, what are they up to? And so that's part of what makes this discussion so great. You're looking at a whole bunch of different factors. You're looking at different time frames than I am. And so, us having this discourse is like super helpful for me.
It is for me too, because I'm learning how to trade longer time frames.
Yeah, and there's a lot of advantages to both. I mean, if you're day trading, you're controlling your risk by being out at the end of the day, or just having shorter time frames on your trades. You may hold overnight sometimes. I don't know, but that.
I have to be profitable a lot. take some off in order to hold overnight.
Yeah, and so it's a way you're managing your risk, and so I'm showing you these other ways in which I'm managing risk for positions I'm holding. So to me it's super interesting. I mean, I love learning how to emulate other people's styles. For me, it's one of the great pleasures of trading, and I've taken all that and just essentially like compiled it into my own style, which is what everyone should do. I'm not a fan of like pick one thing and stick with it. There are people that say that, and they may start making money, and if they settle into something or they have a mentor and settle into a way of trading that works for them. But I don't. The thing I don't like that is eventually the test of time arrives. The market regime changes, and it is, yeah, and it's hard to tell. Are we in winter? Are we in summer or spring or fall? Like, these seasons are, they really kind of blur together, and they can change from one to the other really fast. It's a fickle thing in the markets, and so that's why I like having knowledge of all kinds of different trading styles and being able to measure the market to ascertain, like, well, what kind of regime are we in right now? And what can we expect for the next day, the next week, the next month? It's more than just taking the temperature. It's reading. It's taking readings across a whole lot of different things.
Right. So I do have another one.
All right.
Yeah. This is my last one, and this may make some people grow. HLF.
The Herbalife? Herbalife. All right, yeah. Ooh, Chris, good find. This is in a nice space.
I'm an extreme bear here.
Oh, really?
I see the base, but I am bearish here, and the reason is their last 3 earnings have been horrible.
Okay.
Absolutely disgusting, and they've gotten worse progressively. And on top of that, once again, we have a negative divergence in the daily, where it's making a higher high in the price action, and the RSI has made a lower high, and
you're looking at an 8-period RSI though on the daily, right?
I am.
Okay, because I have a 14 up. Let me switch it to an 8. So that
to a 14.
No,
I'm in 14.
You're in a 14. Okay.
Yeah.
Yeah, but I do see it. What you're talking about, where it's. Go ahead.
It does look like it's ready to roll over. Now let me throw up a 21 EMA on this real quick.
Yeah, that's kind of like rushing up under the price right now, the 21 EMA, which is at 53.77.
What about the 50 SMA?
The 50 SMA is at $50.97. It's quite a ways under the price.
Oh, perfect. Okay, so that's what I'd like it to touch.
Okay. So you have a profit target then on shorts there.
I just, from listening to you a lot, or well, I should say these past 4 days, I've learned that these stocks like to touch the 50.
Yeah, they do, and it touched it in January. It actually it hugged the 50-day. The Bollinger Band got real tight in December, and it hugged like all these moving averages. So I kind of put a ribbon on there. I've got a whole bunch of different like EMAs at shorter time frames, and then I've got the 50-day moving average, and it's just kind of it's a ribbon essentially that I'm looking at.
Okay. So I just threw a fib on it from the 1 year trough to peak.
Okay.
And the 23, which is usually the pullback range, the 23 and the 38, 38 being a deep pullback, the 23 being a normal pullback. The 23 is at 50.4. So for a price target, if you wanted to pin this, is 50.4.
Okay, and that kind of aligns with where that 50-day is, and it may trade below it, and maybe even for some time. I don't know where a 200-day moving average is, but it's above that. So I mean, it's above some moving averages. I don't know that it looks like explosive either way, but I mean, I could see how you'd have a short-term lower target. So what you could do, there are ways that you can do a calendar diagonal that if the price dips temporarily, then you could essentially get a free call. I actually have the book in front of me for once. I'm going to hold the book up. This is Options as a Strategic Investment by Lawrence G. McMillan, and this book it's fantastic. So one of the sections in this book talks about ways you can get a free call option. So I want to talk about that. So if you've got a short-term price target at 50, but short-term, and I'm looking at this and saying, hey, long-term, this thing looks great. Well, there's a chance to get a free call option. So let's look at that. Let's see here, HLF. Let me get a window open on this. I love playing around in this simulator. It's as fun as backtesting. I don't know if backtesting is anything that you spend much time doing, but I have. And playing around with these options combos in this simulator, it reminds me of backtesting.
Oh, okay.
A lot of fun.
My backtesting is looking left.
So yeah, awesome. That's funny. All right, so hey, tell me your timetable here. The target of let's say 51. When do you think that is? 2 weeks, 3 weeks?
I'm pulling up a fib time right now on it.
Man, I wish I brought another one of those beers with me in here. What I need to do is get a keg and have it by my computer, or just like a mini keg or something, so I don't have to get up and go get another one.
They sell mini kegs.
Yeah, I know, but I don't know if they have Lagunitas Hazy Wonder in a mini keg.
All right, that works out great. So, dang it, I can't see it.
All right, so how about this? Let's say 2 weeks, a little over 2 weeks out, March 5th, okay?
March 7th, actually.
March
5th.
Okay. So March 5th, let's sell a 51 call.
Wait, I gotta get over there.
Is that what we're doing? No, wait, hang on.
I'm going over to my options change.
We think here's the trick. We think the price is gonna be at 51 on March 16th, right? So let's sell something that we think is going to be out of the money at that time.
What did I say?
You said March 7th, which translates to the March 5th expiration.
Right.
So we're going to sell a call that we think is going to be out of the money at that time. Okay?
But that's gonna put you. Are you trying to pin this to the expiration date?
No. We're gonna try and get a free call option. We're gonna build a combo like that. I'm gonna show you a trick out of this book.
All right.
And without taking the time to go find the chapter, we're gonna do it from memory. So would it be safe just to say that a 54 call, if we're right, would be out of the money?
Yeah, it might wake, but yeah.
Yeah. So the idea here is, at expiration, the 54 call expires worthless. Okay? So if we sell that now, it gives us a credit of, let's just say, $3.50. Well, there's a fun thing we can do with that. Let's now go shopping for a call that's further out, because we have a longer-term bullish view, right? In other words, if it does go up and make a further, there are a lot of trend lines pointing up, and so if you go far out enough on the calendar, you expect a higher price. Let's say 59, the old high, right? If we go out far enough. So let's go further out. Let's go to May 21st. Okay, look at that. A 60 call.
60 call.
Yeah. So that's all the way out to May 21st. And, this thing, it does have an upward bias. And so the longer out you go, the safer an upward bias has. So we look at this in the combo builder. This is
370.
This is a diagonal spread, is what this is. And so let me explain a few things about this. Yeah, so it actually tells me at the top. It's a May 60, March 5th diagonal. March 54 diagonal. And so the idea here is, if I look in the simulator, the furthest out we go is March 5th, okay? And it looks like, this solid line here. If you notice that the max profits on March 5th happen at the expiration that we sold, right? Like just under it, okay? Because we sold this for some premium, $3 and something cents. And even if it was $54.01, we still collected most of the premium. If it's above 54, then we have a problem. But here's the beauty of it, is if like this is what's so cool about these kind of like calendar diagonals, is the simulator only goes out to March 5th, right? Because the nearest expiration that we're working with is March 5th. At that time, the 54 will expire. And the idea here is we want it to expire worthless. And really, it's best for us if it expires barely worthless. So let me explain a few things. I've traded these before. And what I'll mention is, if you look down, all the way down here on the calendar, you shouldn't probably close this trade out necessarily for a loss here. If it comes down here and loses a little bit, see how it's like minus 40 on the left side? I don't know if you built this combo. Have you built this combo?
No, I don't usually go into my paper trading, so I actually have to go to the screen and look.
Okay, well, I am showing it too. You might have to just wait a moment, and then it'll come up on the stream. But if you look on the left side here, it's showing a $40 loss. Well, what happens is, at this price level, the call is worthless at expiration, and guess what? The March one is worthless, but also your 60 call has lost some money at this price.
Right.
And so, and you can get into a situation where actually they're both just about worthless. Like you might see like 5 cents bid or a nickel bid on the call that you have, because the further down you go, like on March 8th or whatever, the first day where you no longer have the 54 call short, you only have the 60 call. Well, the price is all the way down here at 30. What do you think is going to be the bid on it? A nickel? Less, maybe? The point is, like, you have a free shot. You could sit there with it, and it didn't really cost you anything, right? It's showing like it cost us 40 cents. But if we get executed at midpoint, it actually is for a small credit, okay?
Right.
And so in this case, it's not like minus $40 like this picture is showing. We actually got paid a few pennies. And now we have a call that has no bid in the market, but it might be worth something if the price rises higher. So the point I'm making on this is, if that call the 60 call from May will have a pretty strong bid around 54. 53, 52, 54, that range. The 60 call will still have a pretty strong bid there. And that's why it's showing an estimation that that this combo will be worth quite a bit near that expiration. And so the point is, like, this is how you can get you can, if the price of the underlying moves in a certain path dependent way, you can get a free call option by being right about a call that you sold, right? So anyway,
you see how that comes up and makes a top on your probability analysis thing over here.
Yeah.
That's what I mean by pinning.
Oh.
It's going to rip up and then pin and then drop off. And what you want to catch is that pin.
Yeah, and if we lower the strike, by the way, of the call we're selling, it'll push this higher. Okay, it'll push this spike even higher than 200. However, it may make it so that ultimately, if the price moves higher on you, that it dips lower ultimately. So this is a trade that you're going to take a lot of heat on if you're wrong and the price breaks out while you still have the short call. Like, you don't want the price to break out until after the short call expires. So that's the idea here. So let me just lower the price here and we can look. So say we were like sharpshooters and we thought like, oh yeah, 51 is where it's at. Well, I mean, I don't know that we necessarily like made more profit. It looks like we were still capping out around 200 or whatever, but we're taking on more risk to do it. Oh, I see why. Because it has a bigger look at that. Now the credit line is above zero. So like if the price falls, then we're actually safely well above zero. So we get to pocket that credit. Our call is probably bidless, but we got a good credit out of it. Yeah. All right. So that's some diagonals. That's playing around with diagonals. That's fun stuff.
I'll have to actually practice this.
Yeah, and the other thing to do, I recommend this for everyone. Get this book, Options as a Strategic Investment, by Lawrence G. McMillan. This book, it's like $100 book, but this will be your best investment, man. I promise you. If you spend time with it, that'll be your best investment.
See, my strength is not in building these like put credit spreads and call option spreads. My strength in options, comes from my charting, Fibonacci, using Fibonacci, finding chart patterns, candles, 2 or 3 day candle formations, and then understanding the Greeks, the delta, the gamma, the theta, and understanding how price action will affect those when it goes against you, when it moves with you, so on and so forth.
Yeah, and another thing you mentioned too, Chris, on this one is you said that the earnings story is getting weaker and weaker on it.
Right.
So I mean, in that's a fundamental that can move things. But if this stock has a big short interest, and we can look at that, then like their earnings being weaker and weaker could just be luring in more shorts that end up driving it higher.
I don't know where to look for short interest other than short interest. I think it's shortinterest.com.
Yeah, so Yahoo Finance has some numbers here. Short percent of float, that's pretty high, almost 10% as of January 29th. That's pretty high. Yeah, I mean, it's not like I actually have the site open. Hang on, let me show you. There's a cool site on here. Where is it?
I see Yahoo.
Yeah, I got Yahoo up. There's another site. Hang on, I'll bring it up. High short interest stocks. So it's highshortinterest.com. Now, I was actually looking through these today, and one that actually jumped out at me was KOSS, KOSS. We can look at that real quick. And so, by the way, like the number one is GameStop. Even still, I'm not sure when this was up, when all this data was updated, but that one has 42% short interest. And let's see if we can find Herbalife on this list.
Right, I see why the cost is being shorted right
cut it off before then. Yeah, I mean, it's just fading. Well, and look at the volume, though. The volume's drying up. So here's what it reminds me of. It's kind of like the scenario that we just saw. This is like a miniature version of QS. It's more compact. Like, look at QS, which is now shooting up.
I looked at QS today.
Yeah, I've had this on the Trading Homework broadcast a number of times. And, and I missed it, actually. It gave a really narrow window where it actually leveled off and stopped going down. And I just got a little lazy about looking through every stock on my list, and I didn't look at this one, and I missed that tiny little window. And now the options premiums have exploded higher. I mean, it's plus 31% today.
I was going to suggest QS is a long.
Yeah, it does. It looks good, but I'm going to wait for like a down day or a base or something, because if you look at the previous run, like it did have some like down moves and consolidations where you could get in. Like it looks like it's come back to life. The volume is healthy on it. It's got a great story. Yeah, all these electric vehicle people are talking about it on the Meet Kevin show. I was watching that today. And he had a guest on who was like an electric vehicle expert. Like this guy dismantles the cars. I guess he's got a consulting firm that works with a lot of these electric vehicle companies. And he had some good things to say about QuantumScape. So, I mean, there's a fundamental story there. Jeremy Grantham was talking about QuantumScape in his recent interview. So, but the way I like to get in these things is, I mean, look at this base back here in September through November. That's where I like to build a position. And I've talked on Trading Homework numerous times about how I'm doing that, how I like to build those positions.
Right.
So we can get into that if we have time a little later, but
yeah. I like this to 83.
To 83. Okay. That's not very far. It could be there tomorrow. Or, I mean, maybe by the end of the week, let's say.
It's a gap that's taken to be showed. I can see it.
Yeah. Yeah, great point. That gap back here. Good call. It's got some resistance right there. Okay, well, I could think of a way to play that. Let's go into the options builder here. QS. So yeah, look at that. There's a 85 that you can sell. Although if we look at the really short-term options, so tomorrow, assuming it opens flat, tomorrow by the end of the day, this 75 is going to get real stale. This should experience.
Sorry, what are you in?
I'm looking at QuantumScape 2 days till expiration. I'm looking at 1-inch punch trades on this now.
Okay.
So the 75 call, if you think that it could run up to, into the 80s, this might be a way to look at it, or let's look even lower. It's at 65 right now. That in the money call is just so expensive. Maybe the at the money one. Let's look at that. Performance profile.
470.
If it goes to, there we go. So yeah, I got this one up. The 70 call. You can buy it for $330, and if QuantumScape goes to 84, then you've got a 4-to-1 return. That's okay. That's decent. What if we turn it into a spread, though? Does that sweeten the deal? Let's look. So buying the 70 and selling the 80 Yeah, I like that better. It's got more juice in it. So you could buy this one for probably under
So that just
around
takes
$2.
Oh, no. Okay, I see. I see.
Yeah, I mean, I guess this one's similar. I mean, maybe it's not good. If the bid ask spreads are wide, it's not good. If the bid ask spreads are narrow, it is good. So this has got 4-1 on your money also.
Nickel.
What's that?
It's a nickel.
Wait, which one?
The bid ask.
Oh, yeah. The bid ask spread on the 80. But I'm looking at selling buying the 70, selling the 80. You buy for $2, and so for every dollar invested, you can make $4. If it gets to your target. But I will say that like this one's better at expiration. The other one is better before expiration. And there's really only 2 days to go.
Right. How much data is in this? Ooh.
Yeah, it's a lot. It's bad.
GAM is awful.
Yeah. I mean, you're right. There's a good resistance there at 85, but you're not getting much from, you're not shaving much off the price of the call if you sell an 85. I mean, it's 80 cents. So what if you buy a 75 and sell an 85? What does that look like? I mean that's it's juicy, but it's got to hold up there, all the way till expiration. So I don't know that that's a great way to do it.
So if that takes off $1, that'll be $5. So you make $4.
Yeah.
400 per contract.
Yeah.
And that's assuming it closes the gap.
Right. But I mean, it probably will close the gap. I mean, maybe the way to do it is just buy the at the money call, though. It's so expensive right now.
Well, it's 208 IE.
Yeah, exactly.
That's a lot of premium. And
yeah. All right. Well, what about doing something funky here? What if we like
doing aggressive like I wanted to do with what was it? What was the first one I told you about?
Well, I mean, do you think?
Where you buy the call and sell the put?
Yeah. Well, it's so close to expiration. Yeah. Okay. Let's look at that. So let's buy a call and let's sell the put. I did it at the money. I did the 65. So that takes $2,000 of margin to put on. But at $84, it's 100% return almost on the margin you put up. The other thing is it's open-ended, but it does have some big downside. If the market goes against you, like...
Well, yeah, then you get wrecked.
Yeah, exactly. So I'm not super keen on that one. But what about a back spread? Because this thing's so volatile. Like, what if you sell a 60, buy a 65? I mean, these look pretty liquid. The 60, look at the open interest there. It's almost 10,000 contracts at the 60 strike.
I gotta move over to something else to look for my open interest.
That's okay. Don't worry about it. It's liquid. So
yeah, I see it.
okay. So you sell a 60, buy a 65, and now we have a credit. What can we do with that credit?
Sell 60.
We can buy.
Buy 65. Now your credit.
I mean, you could almost buy a 70.
350.
Yeah, you could almost buy a 70. Let's buy a 70. So okay, this has a margin of $500, but it's got a big kill zone. The odds of price closing in that kill zone are really high. So I'm not crazy about it. It really depends. Like, do you think that do you think it's going to reach it quickly? Because if you think it's going to reach it quickly, what you could do is you could buy the 85 call for almost nothing, and when the price spikes up, like either Friday morning, the price spikes, then you just sell into that before expiration. But if you think that it's going to close and hold that level, you'd want to structure it maybe with like a bull call spread or something different.
I think that there's a very high probability that you get a good candle. I don't know that it's going to close the gap, but I think you're going to get a really good candle tomorrow or Friday. I agree with you.
Yeah.
It's coming out of a squeeze. And squeezes, once they fire, they're not notorious to do like through what John would say is a 3-day thrust, where you just get boom, 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 three green candles in a row.
Yeah. Well, in that case, maybe the best juice you're gonna get is the 85 call, and you know, if it gets to 85, you dump it. You know, like don't hold it.
Right.
So I mean that's probably the best juice you're gonna get on something like that.
So you're buying the 85.
Yeah, and like if you're lucky, the market like gaps down tomorrow and then runs on QS. It could gap down and close at the top. Like that would be ideal.
All right, and then so you buy it and you're selling the what?
No, I'm not selling anything. I'm just buying the 85 call. You know, hypothetically here. I mean, I don't know if I'm going to do it or not, but I'll be watching it. And so the thing about it is, you could do this with you could buy a bunch of these. You know, like instead of posting $2,000 for something that may or may not happen. You know, I mean, it's you could get a handful of these and get some of the similar juice.
Yeah, I put in order for 5 contracts on the open.
Yeah, I would put a limit on it too. I would definitely put a limit on it below where the price is now. I'd have a limit of like, my bid on this would be like 55 or 65 cents, somewhere in that range probably.
You think that would get sold?
Well, I'd be adjusting it if, you know, I'd be adjusting it based on where the price was. Like, you could look at it pre-market and adjust, you know, but like, if the price opens flat, then yeah, it could get filled at 65. If the price opens down, then you could get filled at 55.
Right.
So what you could do is you could spread them out, right? Like you put some of your bid at 55 and some of your bid at 65.
What's the data on this? Oh, it's only 2 cents. No, it's a penny. All right. No, that's a bigger. Duh. All right, there it is. So it's 50 cents.
Yeah, I'm showing theta of 37 cents. So, you know, that's kind of why I'm saying, like, you know, it may not move the full 37 cents by the open, but if the price moves down at all, then it will. It'll move down more than that.
When's earnings?
I doubt that they are by Friday, but let's take a look. QuantumScape. Let's see here. It looks like it did move down a little bit in after hours. Just a smidge. I mean, that can change. Earnings date doesn't even show on Yahoo Finance. I mean, maybe they don't even have earnings calls. Wouldn't that be awesome? I'm kidding. I mean, it's probably just Yahoo Finance doesn't have the data.
Because I'm showing an earnings and a call sign, like those little images, in my instrument under my position. So I'm like, wait a minute, is this earnings week?
I mean, it could be. I don't know. Yahoo Finance doesn't know.
Yeah, it's not showing over here on mine either.
Hey, you made it home. Micah's here. Micah, you have to say hi now on the broadcast. They can't see you. You have to come into camera and say hi.
Hi, Micah.
Wait. There, now you can see if you're in. Your body's in.
You know what? Let me go here.
There she is. Okay. There she is. All right. So you made it home through the wintry mix.
Yeah, you could have come outside, you know.
I shoveled for you.
No.
I shoveled everything.
If you would have saw how I came towards your car, your BMW that you love so much, you would have been out there.
Yikes. Well, why did you, I guess I should just let you park in the garage.
You had to get a running start. And And the way I had to barrel towards your car, you would not have liked it.
Oh my God.
It would have made you cringe.
Oh shit. Yikes. Well, I guess I didn't shovel the driveway good enough. All right, well, I probably should wrap it up soon. Plus, I'm out of beer here at my desk, so I got to go refresh my drink. Let's really quickly run through sectors, because I did want to go through that tonight. So,
we go over the charts.
yeah,
Right.
I'm looking at XLF.
XLF.
Yeah, I don't really have a comment on this one other than like it just crossed over the previous high. It's at the upper Bollinger Band.
I got another negative divergence.
Yeah, it does look like you know what?
High.
It looks similar to one of the charts we were looking at earlier tonight, or maybe it was just earlier in the day I was looking at.
EXAS.
EXAS.
Pretty much, they all look so similar.
Yeah, EXAS looks even more negative than XLF. So by the way, like XLF, it's got some rates fundamentals working for it right now. So I don't know that I'd short it even though it's at the top of the Bollinger Band here. All right, let's jump to XLE.
XLE.
Yeah, very similar chart actually. It's like these two are they are of a similar mind right now.
Another negative divergence.
Yeah, but I mean it is above the high from June of 44.94.
June. Okay, let me see here.
Yeah. Warren Buffett, I think it was just announced that Warren Buffett got into a big stake in Chevron. And Chevron is like the number 2 or number 3 stock in XLE. Let's just take a look at that real quick. I think he sold a bank to do it. Maybe not. I don't know. XLE. I mean, he may not just sell anything and take a big stake.
I don't know why people are piling into oil right now. It's just baffling me.
Ha! Yeah, all right. Chevron is the number 2 holding there. And let me click into it. Let's see if we can find the Warren Buffett news. Yeah, no, it says Warren Buffett. Okay, Warren Buffett bought Chevron stock. Should you? I'll answer that. No, you should not buy Chevron just because Warren Buffett bought it.
Right.
Yeah. CVX. So, I mean, it actually looks kind of good. It's got some big volume up bars here. This is kind of, I mean, these stocks are generally sleepers. They're slow movers. They have pretty liquid options markets, but they're low beta stocks.
Right.
Chevron, it's got a forward dividend of 5.5%. Yeah, gap and go. I think the gap was from the Warren Buffett news. So, yeah, the oil sector is interesting in that it's, even after this run-up, they still are paying big dividends. So I got out of all my MLPs in June, and in my mortgage REITs, I got out of all that stuff in June of last year, and they really haven't gone anywhere since. And now it looks like maybe they're finally breaking out again, maybe. But like you pointed out, like this breakout is like there are some dicey looking things about it. Let's look at a weekly real quick.
Sure.
So yeah, look at that. It's got overhead resistance at 100, and that's not too far off. So, I mean, the last time it got up there, which was June, it failed, and it failed spectacularly. And I was really negative. I thought this stuff was going to keep on going down because, I mean, well, I was walking around outside a lot at that time, and I looked up. There's like no airplanes flying, and I'm listening in my neighborhood, and I hear no traffic. Like I live in they call it South County, and it's not in the city, but it's not really in the suburbs either. It's kind of in the middle. So like off in the distance, I can hear lots of traffic normally, but I wasn't hearing any traffic. So I was like very negative about oil. But before we move off of this, let's look at PCL.
And I'm still not hearing planes flying into audio.
Yeah. Interesting.
Yeah. Don't hear nothing.
But I did not know that. That is a really interesting thing. So let's jump to Jets after we look at CCL. So CCL is looking at a similar base, but to me it looks like more explosive upside. So I'm not going to call this a cup and handle. I'm just going to call it a base. But when I look at this, it's like, okay, there's some strength here, and even though the volume's not super strong, like this thing could explode higher out of it. And it's yeah, and it's not going to hit that resistance. Resistance is still like 40. And so that's.
It does look like it's bullish to me.
Yeah, so I'll tell you what I did. Let me just quickly get into like the long-term campaign concept here, because this is one that you could run a long-term campaign on. A carnival turnaround story. If it had years to put it together, you could do it. So how might one play that? Well, I could tell you what I'm doing. Let's just quickly run that down. And I got to be moving quick now because Micah's back and the boys are here. I got to make dinner, or at least I have to help make dinner. And plus I'm out of beer, so they're in the bedroom back here where I'm filming. I'm out of beer. I should have asked Micah, hey, can you bring me another beverage? She probably would have smacked the back of my head if I did that. All right. So here's what I was looking at, and again, I'm going from memory. I don't recall the exact trade I put on. It doesn't matter, Okay, so a 55 call. That's above that resistance level. But if it had a year to do it and started moving, it could maybe do it. I think it's what I was looking at.
Did you say 55?
Yeah, but let's look at a 40, okay? Because that's a double. Let's look at a 40.
What strike? What change?
The strike is January 21 or January 21st of 22.
Oh, okay.
Yeah, so I'm going way out on this one. And let's put it right where that resistance is. So I don't think this is exactly what I was buying. It might have been. I don't remember. But if the price doubles and it gets there, if we thought that it was going to hit that resistance and then fall back down, that's okay for this. So I think maybe the 40 is what I did get. But let's
pretty much a leap.
Yeah, and so again, this is a long-term campaign. The turnaround story for Carnival is probably not going to be fast. But there are 3 phases to this. I explained the 3 phases yesterday, but I'll quickly go through them again today. So phase 1, let me show you the performance profile on this thing. So if it goes up 100%, forget that calendar. Let's look at. Okay, I'm setting the simulator to 100% move. Okay. And let's say that it takes out to mid-April to get there on a breakout. It might take a little longer. That's okay. We're just trying to get this simulator in a somewhat accurate state. Okay, so we bought this thing per contract for around, let's call it $325. Okay? And the idea here is, Chris, I'm going to be nibbling on down days, okay? So when I might take an initial position now on strength and then add on down days. Yeah, and the reason is a down day hammers an out of the money contract, okay? I'll bring up the chart for this contract in a minute, and you'll see that when it has a down day, it hammers it because it's out of the money. But it actually plays into our favor in this. If we could get our basis to $2, $2.50, something like that, the idea here is this is far enough out that it's going to have some time value. And we're going to know what's up. I know, I'm wrapping things up. I'll be along shortly. Oh, and I'm also thirsty for... All right, fine, never mind. I'll wrap things up and then come get a beer on my own. I'll be along in a minute. Maybe 5. All right, it is getting late here, and we haven't had dinner. All right, so the idea is you want to get your basis low by buying down days. far out. You want more than 9 months to go or thereabouts. Like once it gets to about 9 months, you might want to roll it or consider that, maybe it isn't working, that you need to like abandon the campaign, sell what you have for the time value. But the idea here is this. You see the value, or I'm sorry, the estimated P&L at 40. Let's look at $40. Okay. This contract becomes at the money at 40. Okay.
Right.
And it will have, if we could get our basis a little lower, we'll have made 300%. Okay. That's kind of the idea here. And so what that means, Chris, is that we can buy 3 or 4 times as many contracts and own those at the money, and then we could if we wait until then and buy it at the money then. You see?
Yeah.
And so by doing some long-range planning, if it works out, for the same amount of capital, we can have 3 or 4 times the size of the position size. You see? And so here's the idea. Here's the idea: is by the time it gets to in that time frame where it's only got 6 to 9 months to go, that's when it's do or die time. Because once it gets to 6, be at the money, and if it gets, ideally you want it to get there with about 9 months to go. And you can roll it in so that it's got 3 to 6 months of time to go. Okay? So let's say that.
So wait, let me make sure I get this straight. So you want to be in the money at 6 months, and then you want to close that out and bring it into a shorter time frame?
Yeah. We're gonna try. We're gonna roll it in to have about 3 to 6 months, and really more than 3, like probably 4 to 6 months.
You're trying to capture gamma at the expense of theta.
Yeah, and there's another aspect to it, but yes, that's right. And so when we've got that position, what we can do is something that should be familiar by now for people who've been watching Trading Homework and also our conversations, our numerous conversations. When we have a call that's at the money with 3 to 6 months to go, what am I typically looking to do with that? I'm looking to convert it into a swoosh position.
Right.
And so that's the reason to roll the contract in, is to, from 9 months. This would have about 9 months to go in April to January, right? So I'd be looking to roll it in to where it would have 6 months to go. So from April, I'd be looking to roll that into a September, maybe? A September or October. Okay, so I'd be rolling it in about 3 months, and then guess what I'd be doing? Buying protection with about 3 weeks of duration on it.
Right.
So let's look at what a swoosh position on this right now, just so we can get a feel for what we would be converting it into. Okay.
You can get it's July.
Yeah, you're right. So July would resemble that. So we're going to go into July, and we're talking about now an at-the-money position. So at the money for CCL, where's that? $24. A $25 contract, okay? So we buy the $24 contract, or $25 contract in July, and we're looking to spend between 25 and 35% of this price. We're looking to spend on protection with at least 2 weeks to go. So I'd be looking at March 12th, spending about $1.50 on protection. So we're going to buy an out-of-the-money put for $1.50. There it is.
Did you say March?
March 12th. So there it is at the 22 strike. About 10% away, which is exactly how I like to do it.
But
So,
you're going to be past March. You're going to be in April, right?
I'm just showing a swoosh for right now. So, and then we'll talk about what it would be for the other one. So,
Yeah, if you move forward to September, then okay. Yeah, I got you. I feel you.
yeah. So if we look at this in the simulator right now, what I've got on is I've got a July 25 call, and I've got a March 12th, 22 put. And so now this is a swoosh position. And so what I'd be looking to do is those out of the money calls at 40, when they became in the money at 40, I'd be looking to roll them in so that they have a similar duration as the position we're looking at right now, which from early February to July, that's about 6 months, right? We're looking at the money contract with about 6 months to go, and we're buying protection with about, roughly between 2 and 4 weeks to go, and ideally closer to 4. And you want to keep that rolling. You want it to be about 10% out of the money. And it looks like this swoosh. And so what happens is now we can start to protect the position. And so if this happens, like we talked about at 40, Carnival hits a resistance level. Well, if we can buy puts in this way, what we can do is we can allow that to reduce if the price slides lower. Look at what happens, okay? Say a week later, the price slides lower. Say it falls 20%, okay? Well, here's what happens if this one falls 20%. Is we only lost $18. What that means is we can roll down and strike our calls. So we can roll them 20% lower, which in this case would be 18 or 19 bucks. So we could roll a 25 down to an 18, or we could roll a 40 down to like a 30, or 33 or whatever. And so as the price falls back lower, we can just keep lowering our basis and keep buying protection with a similar duration, keep rolling lower. And if you have to roll in, you can roll in a month, if you need to make it so it's not costing you too much debit to do this. And, it's fine if you roll in from a 6 month to a 5 month. I'm fine with that. If it keeps my contract at the money, because I want that call at the money because it doesn't have much time decay. If you sit with it for a month or two, eventually it's going to, you can expect that if we're still bullish on it, it'll spring higher in price at some point. Well, guess what? Now you have an in-the-money contract, and that's the goal. And so that's phase 2, is we're going to maintain a swoosh position on it. Phase 3, here's what phase 3 is. Phase 3 looks like this. Let me scoot forward in time, and let's look further out. And so phase 3 happens when the price runs in your favor quite a bit. Your call option goes way into the money. Your put is basically worthless. It doesn't take any, it's no longer part of the position. If you look right now, this is above the resistance, okay? And it becomes, it can take on a substantial worth. And so remember, we're buying these things for just tiny, tiny amounts of what it can ultimately be worth. And so in phase 3, the delta gets really close to 1. And if it's a marginable stock, you can convert it, you can exercise it, convert it to shares, and then you can either shuffle it out to a margin account and it becomes a part of your wealth, your holdings, or you can do the wheel on it, or you can just use it as, keep it as a part of your holdings, but, sell calls on it, if you don't mind those eventually getting called away. And then sell puts against that until you get the stock put back to you. That's the wheel. Yeah. And the other thing that you could do is, you could just punch out and take a profit if you want, and pour that into things. There's all kinds of things you do with it once you have it as shares. You could keep those shares in your account and trade against the margin. Use the margin room to open new positions. Because remember, you had a call contract that took up most of your margin. When it's marginable, if you exercise it, then if its delta's close to 1, you're freeing up more margin. If it's a deep in the money contract. So when you free up that margin, like now you can open new positions. Like maybe you start nibbling elsewhere on other things, right? So it's a repeatable process. So anyway, these are all things you could do in those 3 phases. So, hey, with that, I probably need to go, but this was fun. And, we'll try and catch up again with you, Chris, either tomorrow or later in the week. And maybe we'll try and get further through the sectors. There's a lot going on right now.
Yeah, there is.
All right. Well, hey, thanks for joining, and enjoy the rest of your evening.
Thanks for having me.
All right. Yeah. Adios. And hey, everybody, hit likes, hit like, hit thumbs up on the video, please. And you can follow me at Jon Tait on Twitter, JONTAIT. And Chris, you can follow at STFR Trader. That's Sell the Fucking Rip Trader on Twitter.
Yes, sir.
All right. Thanks. Good night, everybody.
Bye.
Bye.